Recently, I bought some silver coins and realized something very strange. Whether it was bullion, coins, or any other form of physical silver, it had crazy premiums in a 20% to 90% range. This so-called premium when you buy coins or bullion is an overvaluation compared to the market price of the metal in question. Simply put, the largest bars have the lowest premiums, and the rarest coins have the highest premiums. This premium corresponds to the rarity of the object you are buying in relation to what it is made of. Usually on ingots we are rather in the 1 to 5% premium, and for coins it is very variable, but we regularly find some with premiums ranging from 5% to 30% to give you an idea. But then why do people, including me, accept to pay 40% more for quite common coins that have no rarity? Today, I have to talk to you about silver trafficking. On the agenda, investment banking, ETFs, and the shenanigans on a rather poorly regulated market. Come on, let's go. A bit of culture to start and understand the magnitude of the gap between the prices displayed on the market at about $25. The long-term trend in silver is bullish. In short, this is not surprising because silver in times of monetary crisis takes on a monetary value to store value. This is less true than for gold because silver is a smaller market and it also has much larger industrial use than gold. But it is still true. When you want to build a basket of precious metals, silver is a possibility to diversify. To buy silver, you can either buy paper silver, i.e. funds or ETFs, whose price will vary according to the market price of silver. In fact, the job of these funds is to make the premium disappear with very low fees, and to allow you to buy and sell very quickly, like any other financial security. In this case for silver, a well-known ETF is the iShares Silver Trust SLV managed by BlackRock. As you can see, the price of the ETF is more or less the same as a market price plus or minus the management fees of the ETF, which are much less important than the premiums. The reflex of the investor who does not know the world of precious metals will be to buy this type of ETF to pay less. We will come to that. Well, let's get back to this premium thing. As a silver ingot, it is not rare at all since it is easy to make when you have silver metal and it is not very beautiful. There is not much work. The mold is quite simple, the premium is the lowest. The bigger the ingot, the uglier it is, and the lower the premium because there's less work to create these ingots in the foundry and less administrative work. Melting a large ingot of 15 kilograms costs less than melting 500 mini ingots of 1 ounce. The advantage of large ingots is the price, and the advantage of small ingots is that it is easier to sell in small pieces. So the small bars are cute because they are more for individuals, and the big ugly bars are more for institutions or richer people who are looking to maximize their value. For gold it's the same, and premiums on bullion generally range from 1% to 5%. Beyond the production costs, what makes a premium vary is the demand. In March 2020, in the midst of the COVID crisis, people flocked to precious metals and the premiums naturally soared. And then there are the coins. Here we just distinguish between collector coins whose price is linked to their rarity as historical objects, and then there are investment coins that we buy to invest in the metal in question. Finally, within the category of investment coins, we must distinguish the coins that are still pressed today from the coins whose quantity is fixed by history. I will not talk about it here either because on silver they are rare and not very useful. But it is necessary to know that it exists and that the premium is often a little higher for a question of rarity. Well, now you know what makes the price of physical silver metal and physical gold at the same time compared to the market price, which is called spot by convention. So why do our bars have premiums of 18 to 20% today? Well, on the Wall Street Bets subreddit, we have a possible answer. Yes, Wall Street Bets is indeed the Reddit forum that caused the GameStop prices to soar and made some hedge funds cough up their lungs. According to the source, it is a JP Morgan bank, the biggest bank in the world, which would be in cahoots with the SLV ETF of BlackRock to manipulate the market prices. If you want the details, go and read the full article on Reddit. There's everything you need, including the sources on the data. For those who are not especially financial or who are too lazy, the principle is simple. Individuals who want to buy silver because it is starting to rise buy the SLV ETF to avoid paying a premium. But then, when the ETF receives a buy order, the bank in charge of buying the physical silver to put it in the name of the ETF sells short the silver at the same time to make the price fall. As the prices fall, the individuals get discouraged and sell their paper silver, making a capital loss. On this chart, you can see that any increase in demand for the SLV ETF is offset by an increase in short selling by banks. When a retail investor sells at a loss, the banks buy back and make a profit. So the ETF charges fees and makes a good living while the bank fleeces the retail investors by playing against them. Welcome to the cute world of Wall Street. In short, the market is manipulated downwards. So if you want to speculate on this bearish bubble bursting, then buy paper gold and be prepared to hold it for a long time. If you just want to buy silver for precautionary savings or to strengthen your positions against government money printing, then buy physical silver with 20% premiums on bullion or 40% premiums on coins. Now you know where the price of physical silver comes from. By the way, all this is not new. It is not exclusive to Wall Street bets. We have known for years that the price of silver is manipulated. So, to date, the physical silver market that is used to determine the spot price of silver is 650 million ounces that are shorted at 500%. This means that this whole setup could blow up in banks' faces. I would obviously advise you not to take part in this kind of game where the victims far outnumber the winners. However, if you buy silver today to keep it for a long term, you could see the price explode if this short squeeze explodes. Personally, I buy my gold and silver from goldbroker.com, and if you want to support me, I have a referral link in the video description. With premiums of 25% on iconic silver coins like the Australian kangaroo or the South African Krugerrand, the upside potential is interesting. Finally, last tip if you want to buy physical gold. Either you keep it by your own means or you use trusted third parties like I do with goldbroker.com to keep it for you. In this case, goldbroker.com delegates the storage to private companies specialized in security like Malka Amit or Brinks, for example. For my part, I also prefer storage abroad in free countries with a reputation for respecting property rights. The ultimate goal is to avoid being stuck with capital or exchange controls. I don't buy paper gold because I'm not a speculator, but rather someone who keeps it for the long term. However, paper gold is used to play the game. However, be careful because thanks to this video, you know who you will have to deal with and what you are exposed to. On that note, see you soon for new videos. Ciao!
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.